The Money Guy Show has over 225,000 subscribers on YouTube, and their 9 financial order of operations have helped more than, I actually don't know how many people they've helped, but it's at least 31. It's at least 31,000. After hearing that, you may be wondering, are the financial order of operations right for me, and should I follow them? The answer is, it depends, and we can answer this by going through each of the 9 financial order of operations and asking a couple of questions to help you make an informed decision. By the way, step 6 is when things get really interesting. But before we take a deep dive into the 9 financial order of operations, I have to tell you why I personally did not follow them. So when I first started my personal finance journey about 2 years ago, I was looking for a step-by-step approach to personal finance. The instruction manual for money, if you will. But everywhere I looked online, there was conflicting messages. Some people said my first step should be to save $1,000. Other people said to invest in my 401k. And some even said that 401ks were a scam. Bruh. For a 21-year-old that didn't have a savings account, but did have a Robinhood investment account, I had some work to do. And work I did. And in the last 2 years, I've been able to save and invest over $100,000. But why didn't I follow the financial order of operations? Well, I didn't follow them because I did not discover them until I was already a few steps into my personal finance journey. But that's enough about me. Let's go through each financial order of operation in detail so you can make an informed decision. Step 1 is to have your deductibles covered. In this step, you would save cash to be able to cover any deductibles you may have in a year. So ask yourself this. Is there a chance that I will have to pay cash out of pocket to cover a deductible for something like a car accident or a health expense or something like that? So if the answer is yes, which it probably is, the next question is this. If I found myself in that situation, do I want to worry about having to sell something, possibly at a loss, to be able to pay for that? The answer is probably no, and I'll give you a personal example. One tooth needed a root canal, and it needed a crown, and I ended up paying about $1,500 out of pocket, and that was after insurance. Well, it sucked that I had to pay for the $1,500 out of pocket, and I probably just should have gone to Mexico to get the dental work done. I didn't really stress about it that much because I had money saved for it. This is money that's better to have and not need than need and not have, especially for dental work, because for some reason, like stuff in your teeth, it really hurts. So now we move on to step 2, and that is to contribute the company match to your 401k. So ask yourself this, now that you've got a safety net in your savings for deductibles, do you want to immediately double some of your money? I'm asking because that is basically what you're doing when you contribute the company match to a 401k, assuming they do 100%. Sometimes they do 50%, but even then, that's a great deal. So for someone with an $80,000 salary, if they contributed 5% because that was a match, they would be putting in $4,000, and then their employer would be matching that. They would be putting in $4,000 for a total of $8,000. That is double of what they put in, and that is before their investments start making money. Moving on, so now that you've got a safety net for your deductibles and you're immediately doubling some of your money, the next question to ask yourself is, do I want a guaranteed return of about up to 25%? For reference, the stock market goes up on average of about 6 to 7% after inflation. I'm asking this because step 3 is to pay off high interest debt. The interest on some debt, like credit card debt, can get pretty damn high. When you pay it off early, you'll stop having to make the payments, and you'll also not be paying that interest anymore. Now you may be wondering, what counts as high interest debt? And that really depends mostly on one thing, and that is how much money your investments would make. If you're looking to pay off something with an interest rate of like 5%, but you know you can make about 7% with your investments, then you may be better off just making the minimum payment on that and not attacking that debt in this step. So just with the first 3 steps of the financial order of operations, you are really setting yourself up. But just in case you're still not sure if they're right for you, which I mean, I wouldn't blame you, we're only a third of the way there, so let's keep going. So now that you've got a small safety net and you're making some big returns on your money, the last thing you want is for something unexpected to happen and wipe out all the progress you've made, right? You can do that with step 4, which is building an emergency reserve. All this means is that you should have some money saved that'll cover between 3 and 6 months of however much money you spend a month. This is one of my favorite steps of the financial order of operations because once you have your emergency reserves, you feel so much more peaceful and confident about your money. If you've never experienced what it's like to be able to go 3 to 6 months without having to make a single penny, I highly recommend working towards it because it is absolutely worth it. The emergency reserves will help you live a life that is not limited by money, which is something we really believe in here. So I want to pause here and point out something about the financial order of operations in case you missed it. Do you guys notice that there's a balance between defense and offense? By defense, I mean you've got some money saved to protect you from things happening, and by offense, I mean you've got some money invested so that it makes you more money. So it helps you win, but it also helps you not lose, which is a powerful combination. So the next step is another another one of my favorite ones because you start to get a little bit into the advanced tax strategies, but don't worry, I won't go into the boring details. This step 5 is to contribute to a Roth IRA. IRA stands for Individual Retirement Account, and also an HSA, which is a health savings account. Now you may be wondering what the heck these accounts are. Basically, a Roth IRA is a retirement account that you set up on your own, as in not with your employer. A health savings account is a really powerful way to save for health expenses, and it can also be used as a retirement account with a secret but not so secret strategy that I won't be covering in this video, but just know it exists. So now you may be asking why you need other retirement accounts if you've already got your 401k from step 2. One of the biggest reasons for this is because of a tax strategy. I'm going to go over a high-level explanation of that tax strategy, assuming you follow the rules for these accounts. With a 401k, you save money on taxes now, but you have to pay them in the future when you withdraw them. This would not be in your favor if taxes are higher in the future. With a Roth IRA, you pay taxes now, but then you don't have to worry about paying taxes in the future. This would not be to your advantage if taxes are less in the future, but with the way the government spends money, I kind of doubt it. That's a big reason I love my Roth IRA. And with an HSA, you will save money on taxes now, and if you use them for their qualified medical expenses, you will never pay taxes. And this one is really powerful. So with no idea how taxes will be in the future, this step sort of helps you diversify that. The big takeaway of this step is that you should invest through a Roth IRA and an HSA before you invest more than the company match in your 401k. Now we get to step 6, which is the interesting one, and that is to max out your retirement accounts. So at this point, you're investing the company match to a 401k, you're investing in a Roth IRA, and you're investing in an HSA if you're eligible. This step is when you should start asking more questions, because I personally believe that everybody should be doing steps 1 through 5, no matter what path to wealth you're going to be taking. Whether you're an entrepreneur or someone that's working a 9 to 5 and slowly saving and investing, I believe that everyone should do at least up to step 5. When you get to step 6, you should be asking yourself this: am I better off maxing out the retirement accounts or not maxing out the retirement accounts and using that extra money to invest in myself so that I can make more money? This depends on things like how much you're already investing in your retirement, how long until you plan to retire, how much risk you're willing to take, and things like that. But don't let not knowing the answer to this question stop you from following the financial order of operations. It may take a while to get to this step, and with more experience, you'll be better able to answer this question. Also keep in mind that when you get to this step, you're probably going to see money a lot differently than you did before you started. Step 7 is called hybrid accumulation, and it means that you're investing 25% of your gross income. But should you follow this step? Well, let's go over it and ask ourselves some questions. Again, this 25% is 25% of your gross income, and it's spread out over accounts like those retirement accounts we talked about, and I think even a brokerage account, if that's part of your retirement plan. According to the Money Guy Show, if you're making less than $100,000 as an individual or $200,000 as a couple, you can include the employer match as part of the 25%. But if you make more than that, you would not. I really like the step because, believe it or not, it is possible to invest too much. A few months into my personal finance journey, I find myself being way too focused on investing as much as I could, like to the point where every time I wanted to buy something, I would feel bad about it or I wouldn't do it. This is absolutely crazy to think about because I was investing something like $2,500 a month and I would struggle to buy a $20 book. So because of this step, I started investing less in the stock market and more in myself. If you're wondering why they chose 25%, it's because if you invest 25%, it'll allow you to replace most or even more of your income when you get to retirement. The earlier you start, the more you can replace. And if you start early enough, you can even make more in retirement than you did while you were working. So now you've got your safety net, you're maxing out your retirement accounts, and you're investing 25% of your gross income, your retirement is looking solid. And the next step is to prepay future expenses. This would include things like a wedding, college for your kids, saving for a car, and things like that. Now, if you've been following closely along, you may be wondering, when the heck do you pay your low interest debt? Maybe you've heard some people say that you should be against all debt, and you know that in step 3, we talked about really attacking that high interest debt. But when do you pay off your low interest debt so that you can finally be debt free? Well, that is where step 9 comes in, and that is to pay off your low interest debt. This comes in way at the end because sometimes you're just better off making the minimum payment and then investing the difference. So now the ultimate question is, are the financial order of operations right for you? But before you answer that, you should know that there are another set of financial steps that have also helped a lot of people, maybe even more people than the financial order of operations, and I talk about those in this video. After you watch that video, you'll know 2 of the most popular instruction manuals for money, and you can make an informed decision.